Good afternoon, everybody. Welcome to this week's Market Huddle. 3 ways to help take back control of your financial future. I will be presenting this today. My name is Tony Whalen. I am one of the financial advisors on staff here at Secured Retirements. So quickly, let me just go through the disclaimers that we have each and every week here. So the information and the opinions that I give, they are subject to change without notice. As always, investments, they involve risk, including loss of principal, and there are no guarantees. Our firm does not assume liability for any loss which might result from reliance by any person upon any such information or opinions. The information and opinions contained herein are for general information only. They don't constitute an offer to sell or solicit any offer to buy a security or investment. They should not be, nor are they intended to be used as a sole basis for financial decisions, nor construed as advice designed to meet the particular need of any individual situation. As always, you should consult your financial advisor prior to making any decision based on any specific information contained herein. Advisory services offered through Secured Retirement Associate Advisors, LLC, registered as an investment advisor with the SEC, only conducts business in states where properly registered or excluded from registration requirements. Insurance services offered separately through Secured Retirement Associates, an affiliated insurance agency. So thank you for bearing with me through that. So again, I want to talk to you about 3 ways that you can help take back control of your financial future. So today I got 3 points that I wanted to run through. First, we're going to take a look and see where we are now. How did we get here financially? Secondly, of course, none of us have a crystal ball, but I just want to take a look, see where things could go from here based on some key indicators. And then finally, and probably most importantly, in my opinion, I want to look at what each of you could be doing right now could help take back control of your financial future. No matter what happens in the government or the viruses or any other circumstances outside of your control. And so, the last couple of years, the markets have seen a lot of different things here, right? So between a global pandemic, which sparked a historic market crash, we've had government-mandated stay-at-home orders, slow return to something resembling normalcy. I don't think any of us could have foreseen events like we've all lived through. You couple that with the market drop that we've seen here in the first half of 2022. Got the Russian invasion in Ukraine. We've got some China-Taiwan tensions happening. So it's easy to think, maybe we're all just doomed at this point, but hopefully we got some good news for you here. So right now, financially speaking, I want to just run through how we got here, and without going too much into the weeds, I do think it's important with all that's happened that we get just a real quick Cliff's Notes style summary of how we got here today. So let's go to the next slide. All right, so Monday, March 16th, 2020, that day marked the single fastest drop in the Dow in U.S. history, falling 2,997 points, or 13% in one day. Over the course of 22 trading days, the S&P fell 30%. To put that in perspective, if you had $1 million that was invested directly in the S&P, it would be down to $700,000 just over 3 weeks. So hundreds of thousands of dollars that likely took years, if not decades, to accumulate would have been gone in less than a month. So market corrections or declines of more than 10% or more are common. Market crashes 30% or more, a lot less so. And we've never seen one happen as quick as we did in March of 2020. In fact, the second, third, fourth quickest 30% drops on Wall Street all occurred during the Great Depression era back in 1934, 31, and 29 respectively. And then the Dow actually plunged a total of 89% during the Great Depression. So after the wild ride we've had here since March of 2020, a few of us would have thought that 2020 was actually going to end better than it started. So after that 30% drop, we actually ended 2020. We set new record highs for the Dow Jones Industrial Average as well as the S&P 500. And then the NASDAQ's 43.6 rally. It was its best performance in more than a decade, since 2009. So while that rapid recovery was definitely nice, it's been a bit unusual. Certainly not something we can always expect as investors. 2022, it started with a 20% drop in the markets. So, all right, here's a snapshot of how we got here. But what else have we seen? Well, we've seen a bit of an inflation concern. Consumers in the markets have definitely taken notice. If you've been to the grocery store, to the gas station, made any large purchases, you've no doubt experienced the effects of rising consumer prices. 2022 is halfway through, and we have been seeing the Fed raising their rates about a 0.75% clip here, 75 basis points, in an effort to slow down the inflation. The jobs numbers report came out for July, actually came out stronger than they were expecting. And so that's kind of continuing that inflation fear. However, right now, it's very likely that the future rate hikes will be less, and they could even end by year end. So current expectations are for a 0.5 point rate hike here at the next Fed meeting in September, but a lot can happen between now and then. As I said, no one's got the crystal ball, but current expectations are for the Fed to begin dropping rates in 2023. All right, so in the last couple of years, we have seen the American Rescue Plan, the Infrastructure Plan. We've seen social spending plans. This does not include the Senate's vote here over the weekend to get the Inflation Reduction Bill working its way through Congress. So we add up all of that, all the different rounds of stimulus, the Fed Reserve's actions during the course of the pandemic, plus the infrastructure spending bills. We're looking at $8 trillion that has racked up some big bills here as a nation. And so one thing we know is that at some point, this must all be repaid. So that's virtually going to assure higher taxes in the future. All that to say, we're seeing and feeling the effects of the inflation right now. So none of us can predict the future, but with pretty high probability, I think we can anticipate a few things. Number one, we'll probably continue to see inflationary pressure on the market. Number two, a lot of people think unemployment is going to continue to pose problems. Although, as I said earlier, the July jobs report showed payrolls increased 528,000 in July, which was much better than expected. And it's a sign of strength for jobs market. But back to number one point, also going to contribute to that inflationary pressure. And so we can expect taxes to rise based on Biden's spending plans, and as the government needs to get paid back for the trillions of dollars of stimulus money and other spending plans. So we'll take a look at our third and final question. It's probably the one that matters most, which is what can you do right now to help take back control of your financial future, regardless of what happens. So as we think about these next few ideas, I'd like you to just consider a couple of questions here. So in times of crisis or emergency, do you consider yourself to be the kind of person that tends to freeze and panic and just let things happen to you? Or are you going to be the person that takes the step aside, gather yourself for a minute, and formulate a plan and take action? So, 3 things that you can do right now. And what we want to be able to do is take advantage of the current circumstances, because the current environment actually creates some opportunities that you should be thinking about. So I'm sure a lot of you guys know who this fella is, but for those that don't, his name is Warren Buffett. For the past 50 years, he's run a company called Berkshire Hathaway. It's a holding company that owns Geico, Duracell, BNSF Railway, Pampered Chef, and a whole multitude of other companies that you've heard of. Warren Buffett is one of the most famous investors alive, currently the 4th wealthiest person in the world, net worth roughly about $103 billion. So what does he have to say about where we are as a country? And if I can move my face out of the way, I could read it. He says, you can bet on America, but you're going to have to be careful about how you bet, simply because markets can do anything. He said that May of 2020. So none of us knows what lies ahead, but the road ahead is likely to be bumpy with tons of things going on right now. We're going to focus on some things that you can do that are in your control. And so in these uncertain times that we've seen, the thing that should be happening is you should be over-communicated to by your financial advisor. This is definitely not the time that you should be chasing someone for answers. And in moments like these, the greatest gift that you can have is often clarity, right? You just want to know what's going on, where things are, where do you stand. If you've spent any time over the past year looking at your accounts and trying to determine on your own exactly where you stand, or even exactly how much you still have at risk, you should definitely be in touch with your advisors. One of the most misunderstood aspects of investing is what it takes to recover from a loss that you incur. In talking with people every week, many are surprised to see how much exposure they actually have in the market. So what do I mean by that? So let's say that you had $1 million in the market and you lost 50%. Okay, so you'd be down $500,000, right? That's all the math that we can handle. Many people simply think, well, with a 50% loss, I obviously need a 50% gain. I'll be back where I started. And unfortunately, that's not how the math works out. And this is one of the most commonly misunderstood things about the market. So as you can see here, if you took the $500,000 that you had left after a 50% loss, and you experienced a 50% gain, you would actually only be back to $750,000. You're still going to be 25% short of where you actually began. So in reality, in order to recover from a 50% loss, you actually need a 100% gain. And so that's why Warren Buffett feels so strongly about avoiding losses. And that's because losses hurt more than gains help. If you experience that 30% loss in the markets, you wouldn't have needed a 30% gain to offset or recover from it. You would actually need about a 43% return, 42.9 for the engineers out there. And so now we actually get to the first action item that we wanted to look at. So the first concrete action that you can put yourself in a better position is to find out exactly how much risk you're still taking. It's not at all uncommon for us to meet with folks that are either in retirement or in a few years of retiring who still have 60, 75% of their assets exposed to the market. And they really didn't even know it. And so what would Buffett say? He would have something to say about it. So he is famous for saying, when it comes to the market, you never know who's swimming naked until the tide goes out. And what that means is a lot of folks, they just don't know how exposed they are on Wall Street until it's too late. He also said, it's insane to risk what you have for something you don't need. In other words, Warren Buffett, not a big fan of taking excess risk, particularly when it's not required to reach your end goal. So that brings us to the action item number 2, which is minimize future taxes wherever it's possible. All right. So to better protect and prepare yourself, and we want to minimize the taxes that you'll be paying in the future. If you're interested in not handing the IRS any more money than necessary, and you'd like to leave as much as possible to kids, charity, whatever, anywhere else other than Uncle Sam, it's a great time now to try to minimize those future taxes whenever it's possible. If you're not in that bulk of folks that are concerned about these, you can ignore it. But and listen, I am not a CPA either, but I do work closely with them. And they're incredible folks, right? The only danger is that assuming that all CPAs are doing tax planning. Reality is some accountants don't function as tax planners, but only as tax preparers. So in other words, they actually function more like historians. And so if you think about it this way, when you talk to your accountant, what are you calling them for? It's to file the tax returns, right? So in other words, they work primarily in the rear view mirror, and they determine what taxes we've already paid. And they're going to try to get back some of the stuff that we've already paid. So they're more like tax retrieving at that point. What we want to do is we want to be able to look at taxes holistically, looking into the future as well as into that rear view. So we want to be able to minimize today the future taxes. All right, so seed or harvest. So if you look at traditional IRAs or individual retirement accounts, they allow you to put in pre-tax dollars. Those dollars grow tax deferred, meaning that you don't pay any taxes until you start taking withdrawals at 59.5 or beyond. People have traditionally loved IRAs because contributions up to a certain limit are tax deductible, and the power of traditional IRAs tax deferral allows those gains to compound on themselves, hopefully going to build you up a nice nest egg over time. Roth IRAs, on the other hand, they're funded with already taxed dollars, and those contributions are not tax deductible. But because you've already paid taxes up front, you don't have to pay them later when you take out distributions in retirement. And while these two types of IRAs have been around for years, they do commonly get confused. So the easiest way to think about them is a simple analogy of a farmer. Farmers have to pay taxes like everyone else. But if you were a farmer and you had your choice, which would you prefer? Would you rather pay taxes on the seed you put into the ground or on the harvest that the seed ultimately became? Because at the end of the day, that's pretty much the difference between a Roth and a traditional IRA. So a Roth IRA, it's equivalent of paying taxes up front or on the seed and never being taxed again. A traditional IRA, it's equivalent to paying taxes later on the harvest, which we don't know what that harvest is going to be. And so we'd prefer, obviously, to pay on the seed and let the harvest grow, take it out tax-free. All right. And then another thing is the foundation. If you've been around secure retirement at all, you know we talk about the income house foundation being the most important piece of that, right? So even though it's boring, the foundation is going to be your income. So if you've got income coming in, you've got that foundation in place. So for the last 30, 40 years, vast majority of you have been receiving regular paychecks. But once you hit retirement, that responsibility of manufacturing those paychecks falls primarily on you. And when it comes to your paychecks, the last thing most of you are going to be looking for is excitement, right? We want to stay boring. We want to know where those funds are coming from, when they're coming in. So Once we hit retirement, we don't want to find crack in the plan, and those could show up in a number of different ways. Could look like a significant loss in the market that might impact the amount you have to create the retirement income. Could look like paychecks that simply don't keep pace with inflation over time. It could look like significant health event that requires you to tap into a big portion of your assets and derail a plan. But the bottom line is generally the same, right? You get one shot at retirement, and nobody wants to see any big surprises. So a true retirement income plan in just a few concise pages in simple English should answer 5 questions. Number 1, it should tell you exactly when the paychecks that you create for yourself in retirement will begin and which money you'll tap into first. Secondly, it should tell you in what order you'll tap into those pockets or buckets of money, because it's important. It's very important. And third, a good retirement income plan, it won't just stay static, because the cost of goods doesn't stay static either, right? We've noticed that definitely over the last year and a half. And so it needs to grow over time. Fourth, it should have built-in provisions for what should happen if you or your spouse should become incapacitated, or if you do require long-term care. And then finally, number 5, and this is perhaps the greatest question we can help you address, it should mathematically show you exactly how long your money will last, regardless of what happens with market crashes or global pandemics. So action number 3, get a written retirement income plan if you're wondering about the income. So the plan does all 5 things that we've just covered. So what does that really mean for you? It means that you can finally put many of your biggest concerns of, do I really have enough? You can put that concern to bed, because we'll test it mathematically for you, ensure exactly how long your money will last, exactly how your plan will work. And if you're first time in the financial life, you'd like to receive some real clarity, have an easy to understand plan, and officially quit worrying about whether or not you have enough, this is by far going to be the number 1, even though it's action number 3. But that's going to be the biggest thing that we would have as a takeaway for you guys. So hope that was enlightening for some. Hopefully it was a little bit of a refresher for most of you. But if you guys have any questions, feel free to reach out to us. We've got the Secure Retirement team here. You can contact us either by phone, 952-460-3260, or you can send us an email, info@securedretirements.com. We'd love to answer any questions that you have, set up some time to go through your accounts, or if you're new, you want to get some analysis, we'd be happy to do that for you as well, no cost on the analysis consultation. Upcoming marketing events, we've got next Monday, we're going to have another market huddle. Bradford Aylen, one of my colleagues, will be discussing current market situations. And then, as always, the last Monday of each month, we're going to have a lunch and learn. It's an opportunity to come into the office. We're going to have up-to-date information based on current events, and every 1 to 2 to 3 months, we'll even just have a fun event. So it could be something on the markets, or it could be just something that people are interested in and want to get some more information. So we'll bring in an expert in that field. Don't know what it's going to be next, but those will be some upcoming events. Again, if you guys have any questions, concerns, feel free to reach out. Otherwise, I hope you all have a fantastic rest of the Monday and an awesome week ahead. Thanks, guys. Have a great day.